bonds control everything in the financial markets. Yet most traders and investors either completely ignore them or don't understand them. And this knowledge gap is costing you money. Understanding bonds and the bond market can help you predict price moves and market shifts before they happen. They can also help explain interest rates that affects your loans, and they can also reveal how professional traders protect their wealth during market crashes. So in the next few minutes, I will explain what a bond is in very simple terms. We'll take a look at the bond markets and things like yields, interest rates, and the relationship between bonds and the financial markets. But all right, so let's begin here with the very important question: what is a bond in the first place? And I actually want to start here with a quote from Ray Dalio, which is a very famous hedge fund manager. And what he basically says is one man's debt is another man's asset. And this quote right here is a great way to think about bonds, and you will definitely understand this quote soon. Because what is a bond? Well, a bond is basically just a loan. A bond is a loan. You lend money to either a government or company, and they promise to pay you back later with interest. That relationship is a bond. So when you buy a bond, you are the one lending money. So a bond is basically a contract that you lend money to someone, and that bond you can think about as a paper and a confirmation that you have lended the money. And why would you do this? Well, you will get paid a fixed amount of money every year. This is called a coupon, and at the end of the bond's term, this is called maturity, you will get your full money back. So let's take a look at a very simple analogy here. Think of it like this. If you give $1,000 to the US government today, and they pay you $40 each year for 10 years, and then return your $1,000 at the end. And this bond certificate or bond paper is valuable to you. This is an asset because you'll get more money later, and it's a debt for the government because the government has to pay you money both every year and at the end of the period. And a bond works in this exact way, but it's basically on a much larger scale. But now let's quickly take a look at the different types of bonds. First of all, we have something called Treasury bonds. And this is something you might have heard about, especially recently. And Treasury bonds are simply bonds issued by the US government, and they are generally considered the safest. We also have corporate bonds, and these are bonds that are issued by companies. And they usually pay more interest because they have more risk. In general, the more risk you take, the more interest you need in order to sort of cover for that risk. You also have something called municipal bonds. This is not as common, but these are bonds issued by states or cities to maybe fund more local projects. But for this presentation, we will focus on treasury bonds because they are by far the most important ones, and these are really the bonds that affect the global markets the most. But alright, so now let's take a look at something very important, because you might be curious about, and you might have heard things like the 2-year treasury yield or the 10-year bond and so on and so on. What does these different things basically mean? Well, what these names simply tell us is how long the bond lasts before you get your money back. So for example, a 2-year bond means that your money is returning in 2 years. A 10-year bond means that you get your money back in 10 years. And as I said earlier, while you wait, you will get interest payments every year. And these different kind of lengths can help both investors and traders plan both around short term, what they think will happen in the short term, which for long-term investors might be 2 years, and more longer term, which might be 10 years or even longer. But right, so now then, what is a yield? This right here is something you're hearing a lot if you're listening to financial news and are interested in financial markets. And in the case of bonds, a yield is just another word for your yearly return on a bond. And so, for example, if a bond pays $40 per year and you paid $1,000 for the bond, the yield is 4%. And here it's important that the yield is pretty much always calculated per year. So even if the bond is 2 years or 10 years, when we say that the yield is 5%, we're talking about 5% per year. So as I said here, when people talk about the 10-year Treasury yield hitting 4%, they mean that investors are getting 4% annual return on that 10-year government bond. But now then, what does the yields actually tell us about, things like growth, inflation, and so on and so on? Well, a rising 10-year yield can mean that investors expect either stronger growth or higher inflation. But what does a falling 10-year yield mean? Well, this can mean investors might be seeking safety. And it can also mean that investors and traders are fearing economic problems. But now, what about the difference in time? So, for example, the 2-year yield basically shows what investors expect, for example, the Federal Reserve to do more in the short term, while a 10-year yield, which is much longer term, can show expectations for the next, perhaps, decade of growth and inflation. But all right, so now, and this is critical to understand, how do bond prices and yields work together? This is a relationship that can be a bit tricky to grasp in the beginning, but I will show you guys a sort of graph here that I really think will help. But first, when bonds are first created, the interest is fixed, but the price of the bond can change and be traded on the market later. So for example, if a bond price goes down, the yield goes up because new buyers will get the same interest payment, but for less money, right? So if the price goes down, if the price goes up, the yield goes down because new buyers pay more for the same interest. So we can imagine this as a seesaw, which I will show you guys right now. But first, a quick example here. So a quick example, a $10,000 bond. Let's say that we have a $10,000 bond that pays $40 a year. That's a 4% yield. But now if the price drops to $900, the $40 per year will be higher because $40 divided by 900 is, higher than $40 divided by 1,000, right? So the yield is now higher. In other words, around 4.4%. And the opposite is true if the price rises to maybe 1,100. Now the same $40 will be less percentage. I hope this makes sense because now, if this doesn't make sense, then this calculator can probably help a lot here. So you see, we have a slider here, and the slider starts at $1,000. So this is the sort of starting price of the bond, and we have an annual interest of $40. Once again, the same example. Now you can use this slider to see what happens to the yield if, for example, the bond price falls. So you can see if the bond price falls all the way down to 700, now the yield have gone up by 42%, because lower prices, higher yield. But what happens when we have higher prices? You can see that the yield has now dropped by 23.1%. So I really hope this calculator can really help you understand bonds. And by the way, guys, if you want to get access to this calculator and more of this presentation that we don't really have time to go over today, please consider becoming a channel member right here on YouTube. For all gold and diamond members here on YouTube, I post all calculators and presentations, so we can really, learn together and improve, especially, during these crazy times in the market. It's so important to really learn about both, economics, finance, and trading. So if you want to join the community, we would love to have you there, and you will get this calculator. But all right, so now let's take a look at why do bond prices change? What are the forces behind this? Well, interest rates in the economy change, and that will affect what people are willing to pay for the current bonds. So for example, if new bonds start offering maybe 4% yield, now your 4% bond looks much worse and the price will fall. And remember, when the price falls, the yield goes up. And the same thing, but the opposite is true if new bonds now only pay 3%. Your 4% bond will look better and the price will go up. So, for example, when the Federal Reserve, which is the central bank of the US, raises interest rates, bond prices typically fall, and when they cut rates, bond prices typically rise. But alright guys, so now let's switch the attention real quick here to TradingView, because now I just want to real quickly show you guys how you can find these US government bonds inside TradingView. And by the way guys, if you for some reason haven't gotten started with TradingView yet, I do have a special link. The link will be both in the description and the top comment, and you can use that to try out TradingView Premium for free for 30 days. TradingView, if you have been following my channel, you know I love TradingView. This is, in my opinion, a must-have tool. Doesn't really matter if you are a trader or investor. This is the place for all things trading and investing. So guys, definitely use that link if you want to try out TradingView Premium for free for 30 days. And I'm pretty sure you will actually continue using it. So now, if we want to find the government bonds and especially the yields here in TradingView, we want to go up here to where it says symbol search. Next, you want to make sure that you have the bond tab pressed right there to make it easier. And then you search for US. Let's say we want to find the 5-year yield. Then I think we press US05 here. You can see that we have something called United States 5-year bonds, and here where it says United States 5-year yield. This is the yield chart we have been talking about in this video, so let's open this one up. And here we are looking at the yield on the daily time frame. So you can see here recently, the yield has been going up a lot in the United States. So in other words, that means that the bond prices have been falling, right? Or in other words, people have been selling off their US bonds, which can basically mean that people are starting to get a bit more uncertain in the US dollar. But alright guys, so I do have some more things to cover right here, but this video is getting a bit long, so I do think I will save the rest of this presentation for our YouTube channel members. So as I said earlier, if you want to become a part of the community and get exclusive tools, exclusive videos, and presentations like this one, while at the same time supporting the channel, please consider becoming a channel member by clicking join down below. And also guys, when you are ready to continue your trading and investing journey, I highly recommend to check out this playlist next.